Hello, everyone. Welcome and thank you for attending our webinar on Regulation A+. Quick housekeeping item before we begin. All lines are muted, but you should have a chat box on your GoToWebinar interface that will allow you to enter in any questions, and we'll try and save about 5 minutes at the end of the presentation for any questions. Also, in the unlikely event of a technical issue, you should also be able to chat with our administrator to resolve any issue that you may encounter. Okay, well, we are officially headlining this presentation, The Rise of the Mini-IPO, the road to New York Stock Exchange and NASDAQ using Regulation A+. But we're here to talk about the current state of Reg A+ generally, which will definitely include a discussion of recent watershed public listings, as well as other Reg A+ related topics that we think broker-dealers and investment advisors will find useful. I'm your moderator, Brandon Raatikka of FactRight, and over the next half an hour or so, I will be talking with two influential attorneys working in the Regulation A and crowdfunding arenas. Let me briefly introduce them to you, if I can get the slide to advance. We're so happy that they could join us today. Scott Andersen is principal of Andersen PC. He has been Deputy Regional Chief Counsel at FINRA, Enforcement Director at FINRA and the New York Stock Exchange, Co-Chief of the Securities Prosecutions Unit of the New York Attorney General's Office, and the Assistant Attorney General for the State of New York. He now concentrates his practice on SEC, FINRA, and state regulatory defense, securities regulatory counseling, as well as working with crowdfunding portals, funding platforms, broker-dealers, and fintech providers on regulatory compliance matters. Georgiades is also an experienced securities attorney and founder of Georgiades and Associates, which is a boutique securities law firm based in New York City, which focuses its practice on alternative finance transactions such as crowdfunding and Regulation A+. His prior experiences range from serving as in-house counsel to a leading middle market broker-dealer, a regulatory counsel to a multi-billion-dollar real estate investment fund, and capital markets associate at a leading New York City corporate finance law firm. Scott and George will forgive me for abbreviating their bios just a bit, otherwise we wouldn't be able to get to their insights. But both have been friends and valuable resources to FactRight as we've wrapped our heads around the Reg A+ industry, so I am excited for them to join us today and help educate our clients. Now, we don't have time to address all of the basics of Reg A+ offerings today, although I'm sure that the guys will touch on some of these aspects in their comments, but there are a lot of great resources out there already that I would be happy to point you in the direction of. Before we get into the discussion, though, let me briefly set the stage by providing an overview of current Regulation A offering activity. Now, at FactRight, we've been analyzing filing and qualification activity of Reg A+ offerings because it's important for us to provide our broker-dealer clients with the due diligence and research perspective they need in order to do business with these offerings. We focus on Tier 2 offerings because they tend to be larger, and for various reasons our clients are more interested in them than Tier 1 offerings. But I'll just briefly share a handful of insights into where the space is now, gleaned from our research database. So this slide shows the number of qualified Tier 2 offerings each quarter since the fourth quarter of 2015, which is when the SEC started qualifying offerings under the new Reg A+ rules. Note that these figures do not include offerings that were later withdrawn or used for merger purposes. But as you can see, qualification activity has grown significantly. And of the 96 qualified offerings represented on this chart, 45% of them have been qualified in just the first half of this year, which is definitely an encouraging sign for this relatively nascent industry. Many of the issuers are seeking to raise the annual statutory maximum of $50 million, as you can see on this slide, but a small majority are looking to raise a max of $20 million or less. Now that's interesting because an issuer can raise up to $20 million under Tier 1, which doesn't require ongoing reporting or audited financials, and at least theoretically may not cost as much to undertake as a Tier 2 offering. A Tier 2 offering, on the other hand, comes with a state blue sky exemption, which is a big reason many companies opt for Tier 2. Also, many companies that intend to go public in the future may welcome Tier 2 reporting requirements. One of the biggest items that we pay attention to is broker-dealer involvement in Reg A Plus offerings. Of the 96 Tier 2 deals, a little over a quarter of them have lead placement agents assisting in the distribution. Not surprisingly, many of the issuers working with broker-dealers have been among the most successful fundraisers in the Reg A Plus universe, even as offering expenses and fees are almost 500 basis points higher for deals involving broker-dealers than those that don't. In addition, many of the most successful fundraisers in the space have been direct participation program issuers. So as you can see from this slide, according to industry classification, real estate related companies such as e-REITs have been popular users of Reg A+. But the majority of issuers are companies operating in other verticals, including manufacturing, tech, and consumer goods and services. Turning from these high-level stats, and if we had the time, we would share a lot more of them with you. Let's drill down on some of the recent developments. So just last month in June, for the first time, we saw companies that had previously issued Reg A Plus securities list them on public exchanges. 2 on the NASDAQ and 1 on the New York Stock Exchange. And that's exciting because as Reg A Plus securities are freely transferable for the most part, industry participants have been anticipating the day in which we would see market liquidity for some of these securities. Note that many other issuers have either had their Reg A Plus securities quoted on OTC markets or intend to do so. So with that, let's turn it over to our panelists. Guys, thank you for being here. We definitely appreciate it. George, I thought maybe we could start with you. Would you briefly walk us through the trio of recent listings?
Sure. First, I'd just like to thank you, Brandon, and everyone at FactRight for organizing this webinar and also for being such great supporters of Reg A+. Really, since inception, you've been down in the trenches with us, working on these different deals, working with regulators to understand how Reg A+ will work, and it's always great knowing that FactRight's part of the working group and taking care of due diligence. Reg A+, as you've shown in your statistics, have really come along. I've seen a lot of successes in the last month and a half as the market has really figured out how to use Reg A+, with 3 companies going to NASDAQ and the New York Stock Exchange. Reg A+ can be used as what they call a stepping stone to becoming a fully reporting public company. A Reg A+ offering, although it follows an SEC review and qualification process along with a 5110 filing and FINRA review process, it's still a private security. You have freely tradable shares, but it's not a registration statement, which makes it very unique. Also a very flexible tool for going public. If you follow the S1 or S11 reporting standard and disclosure requirements, a Reg A+ issuer can become a fully reporting company simply by filing a Form 8A. And that's what we saw in the last month. So the strategy used was pretty simple. It was use the expedited Reg A+ review process and shortened time in terms of a review by the SEC. And if the deal has traction, then take it all the way to one of the major exchanges. So we saw 3 deals over the past about month and a half go to the New York Stock Exchange and NASDAQ. W.R. Hambrecht served as underwriter to a company called ShiftPixie, which closed a $12 million offering and then proceeded to NASDAQ. This deal was syndicated amongst various broker-dealers. So we see Reg A+ being used in 2 different ways, and also a hybrid standard. One is where the company wants to go directly to its crowd. It has a mailing list, a user base of thousands of investors that they want to reach out to. And through Reg A Plus, they can do that and have the broker-dealer process those offerings. And then you have a strategy where they use traditional broker-dealer syndication, where the broker-dealer will follow the traditional standard of building a book and reaching out to different firms into their accounts to sell the deal, and also a hybrid, which is a combination of both. So Shift Pixie raised $12 million. The company is a provider of employment law compliance solutions for businesses that use part-time and temporary workers. The company closed offering, filed its Form 8A, and went right onto NASDAQ. And I believe they rang the bell about 2 weeks ago. Boosted Securities in California, which operates its own funding platform, recently acquired Flash Funders, which they use as the front end to process online technology-driven transactions. They raised $14.2 million for a company called Adomani. The company converts school buses and other trucking fleets into zero-emission electric hybrid vehicles. The company went on to list on NASDAQ following the same process. The third great success in the last month was by TriPoint Global Equities. It used its front-end funding platform called Bank and served as underwriter to Myomo, a medical robotics company that helps patients who are partially paralyzed or have weakened arms to gain further mobility. They raised $5 million through Reg A Plus and also did a simultaneous private placement offering for almost $3 million. They closed the offering, filed the Form 8A, and went on to be the first company to go list on the New York Stock Exchange. So these three successes shows how a broker-dealer can use Reg A Plus to be a stepping stone and take their clients onto a major exchange. We should also note the OTC markets. Last year we saw Elio Motors, which raised about $18 million from 6,000 investors. This was really a crowd direct offering. They did use a broker-dealer called Jumpstart Securities, but Jumpstart Securities was really limited to processing the deal, compliance and execution services as opposed to soliciting. So these are the kind of success stories in different ways that we've seen broker-dealers use Reg A+. And congratulations to those firms for being pioneers.
Great, George. Thanks for that summary. Why do you guys think it's taken this long to see a Reg A Plus issuer become listed on a public exchange, and then why all of a sudden do we have three of them doing so?
You know, I could take that on. It's Scott. By the way, thank you. Glad to be here today. You know, traditionally Reg A was this sleepy exemption that was really not used, and it wasn't used because number one, the amount of money you were limited to raising was $5 million, and number two, there wasn't any state preemption. By the way, state preemption is the reason why everybody does a raise under Tier 2 of Reg A as opposed to Tier 1, because even though you have additional reporting requirements and filing requirements for Tier 2, you get the state preemption. So the fact of the matter is Reg A, which has been around for a very, very long time, was not used for many years. And I think there was quite a bit of pessimism with respect to the use of it. Then number two, when you come up with a new concept like Reg A, you know, this is a regulated entity, a regulated industry, and folks want to be sure that there's a blueprint in place on how these things could be done. And now we see a situation today where we see not only three recent offerings on major exchanges, also marketplaces competing for these listings, as well as the broker-dealers who are involved in these particular offerings, now also talking about launching new offerings. I know TriPoint Global is now talking about bringing public another entity that they're aiming to place on the NYSE. It's called the Bobby's Burger Palace. It's by the Food Network star Bobby Flay. There's another broker-dealer, a wielding company that, believe it or not, is trying to bring a public under Reg A, Chicken Soup for the Soul, which they want to put on the NASDAQ. I was surprised when I heard that until I understood that that entity has 250 published titles, $2.6 million Facebook fans, as well as many other business entities. So I think because it's a regulated entity, there's a little bit of a delay, a lag time for people to kind of test the marketplace and for the compliance folks to get comfortable.
Sure. So both of you guys have kind of touched on this. I think that many people view quote-unquote crowdfunding as maybe the possible advent of disintermediation in the investing space. Can you guys just elaborate on how broker-dealer involvement is critical to Reg A Plus offerings and maybe to the issuers that have undertaken these listings in particular?
George, you want to go first, or you want me to?
Sure, feel free. Go ahead, Scott.
Well, initially, what we saw in the Reg A space was we saw offerings, a lot of offerings occur without the assistance of a broker-dealer syndication or selling groups. We saw some of those offerings successful, such as Elio Motors, which was probably the most successful offering in the first year of Regulation A. There were additional offerings as well by issuers that did not succeed. And some of these did not succeed because, again, with the Jobs Act, which came up with Title IV, which is the new Reg A, you have this new concept of general solicitation. General solicitation permits not only private placement offerings, but also offerings like these Reg A offerings to be generally solicited, which means generally advertised to the general public. So there was this concept in the marketplace that an issuer may be able to raise these funds without utilizing a broker-dealer and without paying that high fee that broker-dealers generally earn. But what we've seen through experience since Reg A has come into place is that issuers benefit greatly by relying on selling groups who go out and sell the securities offerings to their customers. Also, issuers benefit with assistance by helping issuers structure the transaction in an appropriate and fair way. And number three, and one of the most critical things, is how the price is set. It doesn't really behoove people to invest in an offering where a price point for a share is set almost randomly. And having the broker-dealer community provide some guidance in this area to make the offering more attractive to investors makes very good sense.
Great. George, what do you
I agree with that.
Yeah,
I completely agree with Scott. We've seen a lot of early movers in the industry attempt to go to market without having the guidance of a broker-dealer. I think most people forget that a broker-dealer's role in an offering is not just introduction to capital. It's everything that goes on before that in positioning the company, valuation analysis, understanding what the terms of the offering should be, educating management on what it requires to do an offering, preparing an investor relations program. So there's a lot more advice and guidance and value that a broker-dealer adds. Some of the early movers had attempted to go to market without that advice, and many advisors had taken advantage of the fact that you don't necessarily need a broker-dealer for these different finance programs under the Jobs Act. And they quickly learned an old maxim that we've all known on Wall Street, that securities aren't bought, they're sold. That there has to be something more than simply posting on a website or a funding platform. There needs to be a more targeted approach to who you're going to sell to, how you're going to develop the company's profile, and what your investor relations program is going to look like. So although we've seen some unsuccessful offerings, it's not really an issue with the regulations themselves. I think it's really the industry understanding how best to use these new rules to bring these new companies and these new offerings to market.
So then what types of issuers do you think will have the best chance to raise sufficient capital to achieve their objectives and potentially list? That's probably a good due diligence consideration. Would you say it's an issuer that aligns itself with the broker-dealer early in the process, or what other things should we be looking for in terms of sort of projecting the success of a Reg A Plus issuer?
I think having go ahead.
Oh, I'm sorry. Go ahead, George.
No, please go ahead, Scott.
You probably have something better to say than I do. Go ahead.
No, feel free.
Yeah, I was just going to say that what we've seen is we've seen a history of issuers. The first concept is, as George indicated, securities really need to be sold. They're not going to be bought just by people surfing the internet. And what we've seen that the early movers and shakers in this space have been very successful, who have kind of become experts on the thought process on how properly to market this place to capture investor interest. And the best targets for that type of interest, Brandon, is issuers who have, number one, large, loyal customer base who are very, very happy to quickly turn into investors themselves. Keep in mind, with Reg A, unlike Reg D, you're able to offer securities to non-accredited investors. Non-accredited investors, of course, are going to invest less, but for companies, there's a recent company that is doing a Reg A offering called BrewDog, which has very, very adamant, loyal customers who want to own a piece of the business as well, and that provides another opportunity for an issuer to think in terms of how they could raise the capital that they need to continue their operations.
Yeah, we were we did the due diligence on BrewDog, and we were disappointed that we weren't offered a sample of the product. George, would you add anything to that?
I completely agree with Scott. It depends on the structure. One of the reasons we have a lot of issuers, so this is very much an issuer-driven program, interested in doing this type of offering, they're not only looking for capital, they're looking to connect with their user base, with the thousands or hundreds of thousands or millions of users on Facebook who are connected to them, people who use their product, their service providers, and to convert them into brand ambassadors. And that was BrewDog's strategy. I mean, for those who don't know, BrewDog was a microbrewery in Scotland. 10 years ago, was on the verge of bankruptcy, did not have access to capital, did a crowdfunding campaign in the UK, and through a series of crowdfunding offerings, I think they obtained over 40,000 investors. And we were all part of their Reg A Plus offering last year, this time actually, in the US. Last month, the company had a $1 billion valuation with a $200 million venture capital investment. Their strategy was to take investors and bring them part of the company, make them brand ambassadors. So we see a lot of issuers who want to pursue that very strategy. So companies who have, as Scott said, that consumer-facing profile, this is a great tool to use. For those that don't necessarily have that access to those users, that's where the broker-dealer would take a different approach, which is the more traditional syndication, reaching out to their account holders, to their brokers, and to other brokerage firms to use the benefits of Reg A as more of a stepping stone and expedited process that you get in moving through the regulatory process. And then if it's successful, you can jump onto one of the exchanges and go fully public.
So we've touched on this a little bit. It seems that broker-dealer involvement is critical to a lot of these types of issuers. Turning to broker-dealers, why should broker-dealers be interested in these offerings? What benefits are in it for their clients? Well,
again, as we've discussed, this is another way for an issuer to raise capital. It's different from Reg D because, again, with Reg D, you're limited to accredited investors if you're using the general solicitation provisions of Rule 506C. So really, what you're looking at here is you're looking for an opportunity for issuers to raise money, target non-accredited investors. Because of the amount that you could raise, I mean, theoretically, you could raise $50 million in a 12-month period under Reg A. There is sufficient capital there to pay broker-dealers compensation. So to me, it's a win-win proposition for both parties. The issuer benefits by having the broker-dealer involved, which provides more likelihood of success of the offering, as well as appropriate investor protection. And the issuer and the broker-dealer benefits because it provides another opportunity for business that a broker-dealer could be involved with. Now that we have some of these trailblazers, we have clear guidance as to how these things need to be done to be compliant with SEC regulations and FINRA rules.
we've worked, both Scott and I, with a number of broker-dealers and looking at their model, understanding how they can use these different financing programs, looking over their written supervisory procedures to discuss compliance issues. And I think many in the industry see this in kind of two ways. One is there's a new market out there of issuers who want to use this type of offering and this type of process or distribution channel to offer securities to their network. So to the extent firms want to be part of that growing industry, then this is how they need to go about understanding how it works and incorporating technology into their use, into their platform and how they offer private securities. Many were interested in seeing Elio Motors raise, not the amount they raised, but from the number of investors. And some broker-dealers see that as an interesting dynamic to how to expand their firm and their accounts. With 6,000 new potential investors, users who now know about the firm, really driven by the issuer's desire to connect with its users and prospective investor base, and issuer-directed marketing, we put it that way. So it's an interesting new type of product line to add to a broker-dealer and to the firm. And I think the second issue is a more wider consideration, and that is using technology to drive both compliance and how offerings are made. The old days of sending subscription agreements by email to a couple of investors and then tracking them with spreadsheets for private placement financings, this is the 506C world, are quickly fading as broker-dealers are merging into fintech companies. With new technology providers, one of them we had in our article, I think, was Fund America, provide dashboards and transaction wizards to allow investors to go to your platform, fill out the subscription information, and by electronically signing and emailing, you can have a document trail of who signed, who subscribed when, with money flowing directly into escrow using ACH and other payment processing methods. So it takes a part of the industry that was largely done offline into a more streamlined, efficient electronic process. We've seen companies, private funds use 506C to raise $200 million plus using this type of process. We're seeing these types of subscriptions being processed online for Reg A plus, in addition to the traditional broker-dealer syndication. So I think it's really modernizing how broker-dealers offer securities. When we look at the social media world with over 1 billion users on Facebook in any given month, and Twitter and all these other ways of connecting, and how we transact our daily businesses, it's a unique and powerful tool for broker-dealers to now understand how they can leverage this new way of communicating and transacting business for their underwriting for their transactions.
So what you're saying is that the innovation that Regulation A plus is helping to drive is really going to transcend the Regulation A plus and extend to the securities business at large.
Correct. And I think it's largely driven by not only issuers but also investors who they want to subscribe to offerings by clicking a button and electronically signing documents and wiring their subscription amounts, as opposed to, I remember as a law firm associate of emailing subscription agreements, warrants, and units and asking people to physically sign and sending back and forth, tracking everything on Excel. Things have modernized, and it's really very much investor-driven.
Yeah, I mean, conceptually, you have a situation where you could be at a social gathering talking to a colleague about a particular offering, and that person could take out their iPhone, go to the website where the offering is posted, hit the Fund America Invest Now button, and go ahead and enter an investment. It's becoming that easy, and that technology is available now for use.
So you guys are both lawyers. What kind of securities are these? George, you mentioned that these are private. Are they being treated as private securities by regulators?
It's a great question. So Regulation A+, although it goes through an SEC review process and qualification process, broker-dealers are still required to file a 5110 form, although about a year and a half ago we were arguing that because it's a private security, 5110 wouldn't apply. FINRA was having none of it. You still have to file a 5110 form. So it is a private security. It is freely tradable, but it is considered a public offering by the very nature of how it's offered and how it goes through the SEC process. Same with 506C, where it's considered a a publicly marketed private place. There is no requirement necessarily that a company go on to an exchange. Although we discussed these very interesting successes where companies have used Reg A Plus successfully to go on to the New York Stock Exchange and NASDAQ, there have also been a lot of successes where, by the very nature of the business, there was no need to go on to exchange. For example, the advent of the E-REIT, which is basically an evolution of the non-traded REIT, where we have real estate sponsors who love this type of offering because it allows them to reach non-accredited investors and bring non-accredited investors into their different real estate developments and developments of REITs. Fundrise was one of the pioneers in using Reg A Plus, and I believe they're on their 4th or 5th Reg A Plus offering at $50 million, and also did a Reg A Plus offering for their for the parent company as well. So there's no requirement necessarily that you go into an exchange. It's part of the analysis of whether this is something that investors are looking for. Real estate is a bit of a different type of company, type of product when you're offering to investors, and we've seen a lot of success in that space.
So then, Scott, what does the FINRA 5110 process look like for Reg A Plus securities? Is it different than other types of securities that are reviewed under that rule?
It's a process where FINRA essentially reviews the fairness of the compensation earned by a broker-dealer. The filing has to be made with FINRA almost immediately at the time that the filing is made with the SEC under FINRA rules. And then FINRA will go through a review process determining all compensation, whether it's cash or non-cash compensation earned by the broker-dealer, to make a determination whether that compensation is fair and reasonable. That's the process. It's a typical inquiry process where you'll have the FINRA examiner write comments and ask questions, and then if there's any issues with the particular offering, make some objections. George has done a ton of these 5110 filings with Reg A, and he probably has some better thoughts than I do with respect to it.
I completely agree with you, Scott. It is the standard 5110 process in terms of questions and filing requirements. However, there are some unique elements that's important to get right to ensure that there aren't delays. And we have seen regulatory delays in several offerings, which have really slowed down the process and caused some friction, especially when everyone's eager to get to market and investors are interested. One is, as Scott mentioned, is compensation. Depending on how these are structured, who the technology platform is, the relationship between the parties, it's important to make sure that all compensation is fully disclosed to ensure that you include in the 1A, in the offering documents, all the necessary requirements under Form 1A and also under 5110, which disclose the broker-dealer's role in the plan of distribution. Again, it's a unique process on how funds will be processed online, so you want to make sure that that is carefully detailed to investors on if they're going through a portal or platform or it's an online subscription process, that they understand how money will flow into escrow. So it's important to get these types of disclosures and descriptions accurately to get the process moving as soon as possible and to reduce follow-up questions with regulators.
Thank you, George. Well, we're running up against the clock here, guys, so I want to pause here just to see if there are any questions from our audience. And again, you can submit questions via chat. And I've just confirmed that we don't have any questions. Obviously, we have the contact info for Scott and George up on this slide, so if there's any follow-up, you can certainly reach out to them directly. As we conclude here, I thought I'd ask you guys for any parting thoughts for broker-dealers who are looking to get into this space. Any tips or advice that you would have for them?
Yeah, I'll go first. I would say that Reg A. Now we've seen that there's increased interest. We see momentum building for this type of process to bring listings on exchanges, large exchanges, NYSE, NASDAQ, OTC markets as well, is very interested in working on these types of transactions. Keep in mind, as we discussed, there are specific regulatory requirements that a broker-dealer has to be mindful of with respect to a Reg A offering. We talked about the 5110 process and filing requirement, which is a broker-dealer requirement. A broker-dealer is not permitted to participate in any offering in the absence of doing that filing. And then the other compliance-related comments I would make is keep in mind, to update your WSPs. One of the things to focus on is if you are targeting non-accredited investors, there's an investment limitation where they cannot invest more than 10% of the higher of their net income or net worth. I'm sorry, annual income or net worth. So you want to be very mindful to make sure that those are complied with. Of course, it's similar to the old 506B requirement where an investor could just affirm that they meet that standard. If you're out making recommendations, of course, you have your suitability and your due diligence obligations. For due diligence, always best to use a third-party due diligence provider. Speaking from experience here as a former FINRA enforcement lawyer, it's very helpful. FactRight does a very, very nice job with respect to that work. I think that covers it.
Great. George, anything to add?
I would just add that the Jobs Act that came out in 2012, the goal was to really refashion our private capital markets to allow greater access to capital to private companies. And it certainly has done that. It's done that with crowdfunding, with Regulation A+, with generally solicited private placements. With that has come new opportunities for broker-dealers. Technology has fueled the evolution of the broker-dealer into really a fintech platform and created new distribution channels, new ways of engaging issuers, engaging investors. And this market is clearly growing with these recent successes. I think people have gotten a hang of how these new tools can be used. And it is quite an interesting market for firms to both expand the issuers they work with and prospective investors. So I think that these three companies, and I congratulate the broker-dealers and the firms that are pioneers, are just the first to make. And look forward to it. It may sound a little scary and daunting as everything that needs to be done as a new process, but I think with the right legal counsel and the right compliance team giving thought to the issues that Scott mentioned, having your written supervisory procedures in place in advance and your offering process reviewed, it's a great way for broker-dealers to expand their business and to play a meaningful role in helping these companies raise capital.
And you guys, hopefully you guys have a few extra minutes here. We just got a couple questions in, if you guys are still available.
Yeah, of course.
First question from the audience: can these be traded at most of the custodians? I know broker-dealers are interested in that question for sure.
I believe so. I think there was some early hesitations and considerations early on, a year and a half ago, but everyone's become a lot more familiar with what a Reg Plus security is. I remember when we were doing Hamburg was doing the 211 form to become a market maker for the Elio going into the OTC. It just took a lot more consideration. Everyone's studying to figure out, well, what is a Reg A Plus? It's a private security, but freely tradable. Now I think everyone's become a lot more comfortable with what this type of security is and how it fits into the process, including custodians.
Yeah, I'll just add to that. Yeah, George is 100% right. In the very beginning, broker dealers were reluctant to take the shares into their accounts because they didn't know what they were. They assumed that they were, a Reg D subject to Rule 144, micro cap type offerings and things of that nature, and there was a lot of hesitancy. But the marketplace has been much more educated since those beginning early days. And again, I mean, this is a freely tradable security, and custodians are well understanding that this is what Reg A is and how it could be used.
Great, thank you. And then the next question is more issuer oriented. An audience member wants to know what the costs are for launching a Reg A Plus offering, and also what the demand is for this type of offering for income-producing real estate, which I think we touched on a little bit. But
Yeah, I'll go first with that. My one comment, I'm not a transactional attorney, so I'll defer to George on kind of what the cost would be for an issuer, but I will say in my conversations with securities transactional attorneys, this is way, 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 way cheaper for an issuer than doing like an IPO. It's a different ballgame entirely, and it makes what was once not possible for an issuer now possible again to get on an exchange or get on the OTC and move forward on that basis. With respect to real estate, what we've seen in the very beginning of the marketplace, both Reg A and Reg D, with the exception of the Jobs Act, is extreme interest on the real estate side. In a certain way, I tend to view the Jobs Act as the intersection between the real estate industry and the securities industry, because you had a whole host of real estate professionals who wanted to use the easy ability to raise capital over the internet by general solicitation for their securities offerings, and that side of the business has been booming. In fact, I'd even go so far to say that there was never really any delay in the momentum on that piece of the business. What we've seen is a bunch of funding platforms raising capital for real estate type offerings, and now we are beginning to see that industry moving the way, as George described, to the e-REIT, where basically it's a play on the non-traded REIT, where the offerings are done online and investments are made through a funding portal. And by the way, I'll add to that, we're seeing some of the bigger players in this becoming registered broker-dealers to do this business. A name that jumps out to me is Realty Mogul. FactRight that George had mentioned earlier is conducting its business as a registered investment advisor.
Yeah, at least from our standpoint, we kind of see two different Reg A plus markets. You have the direct participation programs, which are primarily real estate issuers that are really using Reg A plus as a wrapper. It's not necessarily a description of a strategy or anything like that. And then we have, for lack of a better term, the operating companies, which are a bit more esoteric, at least for a lot of our clients to understand. I think real estate has gotten a lot of traction because it's an asset that's easily understandable. And we've seen a few sponsors that we've worked with or reviewed on either the public non-traded or the Regulation D side of the business that have moved into the Reg A plus space with great effect. So I don't think there are any more questions. Again, we have Scott and George's contact info up here. I just, at this point, I think we'll wrap up. Thank you so much for attending, and I want to thank Scott and George for their insights. I'm going to leave their contact information up for the next minute or so, if you'd like to jot it down. And again, we appreciate your attendance today on the webinar. Thank you very much.
Thank you,
Brandon, thanks for having us. Thank you so much. Bye-bye.
Bye.